Welcome to Tech Money Madness, your daily U.S. stock market podcast, April 15th, 2026. I'm so glad you're joining us today because we have a really wild one to talk about.
Yeah, wild is probably an understatement.
Right. I mean, usually when you look at the thermometer, it gives you one temperature. It's either a sunny 75 degrees or freezing 30 degrees.
Sure, you don't get both at the exact same time.
Exactly. You don't expect the thermometer to tell you that your head is somehow baking in an oven while your feet are simultaneously encased in a block of ice.
That would be a serious medical emergency.
It really would. But, if you look at the daily market briefing for today, that economic split personality is exactly what we were dealing with.
Yeah, the data is completely bifurcated.
It is. And our mission for today's deep dive is really just trying to make sense of this wildly contradictory stock market. Because on one hand, the S&P 500 just hit an all-time high of 7,000 today.
Which is just a staggering milestone for the index.
Huge. But then on the other hand, at the exact same moment, the International Energy Agency is officially declaring that the world is facing the largest energy supply disruption in modern history.
Right. It's a really jarring juxtaposition. We are seeing unprecedented wealth creation on paper happening simultaneously with a severe physical crisis in the real world.
Yeah, it's wild.
I mean, it's a complete divergence between what the financial metrics say is happening and what physical supply chains are actually experiencing on the ground.
And the sources we're looking at today reflect that bizarre mix perfectly. We've got corporate space races, surging tech stocks, heavy geopolitical conflict, and we're even going to get into the underlying economics of your backyard barbecue.
Which is entirely by design, honestly, because that macro-level volatility always trickles down to the micro level of daily life. The real question is just how fast it happens and, which sectors get burned first.
Okay, let's unpack this. The daily index moves from today perfectly illustrate this massive split between the traditional economy and the tech sector.
They really do.
It was technically a mixed day. The S&P 500, like I mentioned, crossed that historic 7,000 mark. The Nasdaq-100 also posted modest gains. But the Dow Jones actually declined by 0.5%.
Right, so you have this divergence right out of the gate.
Exactly. We've been looking at this, and it feels less like a unified market and more like watching a three-horse race, right? Where one horse is flying with the jetpack, one is jogging, and the other is just, running backward.
That's a great analogy. The Dow is definitely the one running backward today.
Yeah, because that 0.5% drop in the Dow was heavily dragged down by a significant price swing in Goldman Sachs, which was down 0.7%, and Caterpillar, which took an absolute beating, down 4.5%.
What's fascinating here is the actual mechanism of how these indices are constructed, because that dictates how we perceive the health of the entire economy.
Right, the weighting matters.
Exactly. The S&P 500 is market capitalization weighted. That means a $3 trillion tech company has exponentially more influence on the index's direction than, say, a $50 billion manufacturing company.
So the big guys just drag the whole average up.
Right. So your jetpack horse metaphor is spot on. A handful of massive tech engines are pulling the entire market average up. But the Dow Jones, conversely, is price-weighted and much narrower. It only has 30 blue-chip companies.
Which means it tends to reflect those older, more traditional industrial and financial powerhouses, right?
Yes, and if we look at the underlying reality there, we're seeing the friction of the physical economy. Companies that require massive amounts of energy, heavy materials, and complex global supply chains are suffocating.
But the tech sector isn't feeling that at all.
No. The digital economy companies dealing in software, custom silicon, data, they are operating in an entirely different paradigm. They are completely insulated from the dirt and the diesel, at least for now.
Well, if the industrial hull is on fire, the tech engines are definitely running hot. Let's look at the specific market movers driving this tech surge. Tesla is the top gainer on the board today, surging 6.1%.
And that's just ahead of their earnings report, too.
Yeah, driven by some really bullish analyst notes and custom chip developments. Plus, Microsoft is up 5.3%, and Apple is up 2.5%.
Strong days across the board for big tech.
For sure. But looking at the sources, there's a projection regarding NVIDIA that I really have to push back on. Analysts are projecting that NVIDIA's stock could double by 2030.
I know, it sounds crazy.
Oh, doubling by 2030.
Yeah.
After the massive historic run it's already had, aren't investors worried these companies are spending way too much on tech infrastructure? I mean, these hyperscalers are pouring hundreds of billions into capital expenditure.
It is the most critical question in the market right now. The prevailing fear is that this massive capital expenditure, this CapEx, is just totally unsustainable.
Right, because surely there's a natural limit to how many server farms we actually need.
You would think so. But the reason analysts are projecting that kind of continued growth for NVIDIA, despite all this market pessimism over infrastructure spending, is because the definition of tech infrastructure is physically escaping the atmosphere.
Oh, wow. Which brings in the Amazon news from today's sources.
Mm.
They just acquired the satellite operator Globalstar.
Exactly. And that is not a minor acquisition. Amazon bought Globalstar to strategically strengthen its own satellite communications ambitions.
Right, they want their own network in orbit.
Yes. Now, pair that acquisition with the ongoing buzz we're seeing around SpaceX's upcoming initial public offering. What we are witnessing isn't just companies building better AI chatbots anymore.
It's way bigger than that.
It is. We are watching an escalating space race among the world's largest corporate players.
So it's a literal physical expansion into low Earth orbit. They're basically taking the data center concept and putting it in space.
Yes, and this physical and digital expansion explains why the massive infrastructure and custom chip investments are happening, like Tesla's custom chips, or NVIDIA selling next-generation hardware to Amazon.
They're building the hardware for space.
Exactly. They are building the nervous system for an entirely new orbital economy. The sheer scale of compute required to manage a proprietary global satellite network, it's mathematically staggering.
That reframes the entire tech bubble argument. If the infrastructure spend isn't just about software, but rather a massive hardware land grab in space, a potential NVIDIA doubling suddenly seems a lot less absurd.
Precisely. They are selling the picks and shovels for the colonization of low Earth orbit. The tech sector is essentially building its own independent infrastructure up there.
Wow.
Yeah, they're trying to build a global network that relies less on traditional earthly constraints. But of course, building rockets and servers still requires raw materials.
Which brings us crashing right back down to Earth. Because while Amazon and SpaceX are looking at the stars, the physical resources on this planet are under severe, historic stress.
Unprecedented stress, really.
Yeah, and I want to pause here and explicitly state something for you listening. When we are discussing the ongoing Iran conflict and its political ramifications today, we are purely analyzing the economic data and reporting the facts from the sources.
Right, an important caveat.
Exactly. We are absolutely not endorsing any viewpoints or taking any political sides here. We're just looking at the math. And setting the politics aside, the math is brutal. The sources estimate $58 billion in direct damage to energy infrastructure.
$58 billion. That is a massive hit to global energy supply.
And the sources note that this kind of physical destruction will take years to fully repair. The World Bank president even warned today that this conflict could lead to months of ongoing disruption, even after the Hormuz Strait reopens.
This is a classic example of how the market consistently misprices long-term structural risk. The financial system is relatively good at pricing in temporary supply shocks.
Like a shipping lane closing for a few weeks.
Exactly. If a route closes, ships take the longer way around Africa, freight prices spike, and then they eventually settle. The market understands that cycle. But physical destruction of multi-billion-dollar refineries, that is a fundamental removal of supply from the global equation.
And you can't just throw money at a destroyed refinery and have it working the next day. Rebuilding requires specialized steel, complex engineering talent, and time.
All of which are severely bottlenecked right now, which is why the International Energy Agency is not mincing words.
Right, declaring it the largest energy supply disruption in modern history.
Yes.
Yeah.
That officially changes the baseline for the entire global economy. Every single physical good just got structurally more expensive to produce and transport.
Which perfectly explains why Caterpillar took that 4.5% hit today. They're essentially a proxy for the physical world, right?
Exactly. They build the heavy machinery that extracts raw materials.
Right, so if global energy costs spike because of a historic supply disruption, Caterpillar's profit margins just get destroyed.
And it's not just their internal operating costs, it's the behavior of their customers. If you are a global mining conglomerate and the cost of diesel fuel suddenly doubles, your mining operation stalls.
Because it's suddenly too expensive to dig.
Right. The profit margins on extracting copper or iron or just vanish into the fuel tank. So you delay buying new equipment. Construction firms delay new projects.
And Caterpillar feels that demand destruction immediately.
Yes. The tech giants in Silicon Valley might be insulated from a spike in diesel prices, but Caterpillar's entire business model is predicated on affordable, reliable global energy.
So we have tech building server farms in space, completely detached from the dirt, while the companies actually moving the dirt are suffocating from a lack of affordable energy.
It's a tale of two economies.
It really is. But if energy is incredibly expensive and the tech sector is hoarding all the investment capital, how is the average consumer affording anything? Let's look at the banking data today.
That's where it gets interesting.
Right, because Bank of America posted their Q1 earnings, and they beat expectations. They came in with an earnings per share of $1.11 and a massive $30.3 billion in revenue.
Which reveals the hidden mechanism keeping the traditional economy afloat right now. It's consumer credit.
People are just swiping the card.
Exactly. Despite the energy crisis, despite the geopolitical tension, the American consumer is still transacting. Strong revenue from a major consumer bank like B of A suggests people are still spending, but crucially, they are borrowing to do it.
So credit utilizations is basically masking the economic pain of those underlying physical shortages.
Yes, for now.
Okay, here's where it gets really interesting. Because you listening to this, you're absolutely feeling the pain of those physical shortages. When you take all this high-level data, the booming tech sector, the paralyzed supply chains, the strong banking revenue, and you look for where the average person feels it.
It's at the grocery store.
Specifically, it's cows. According to today's data, cattle prices have soared to absolute record highs. Cattle futures contracts have jumped more than 25% over the past 12 months.
Just in time for grilling season, too.
Exactly. While Wall Street is obsessed with artificial intelligence and orbital satellites, you are going to feel this economy's massive inflation most directly when you go to buy a steak.
If we connect this to the bigger picture, that 25% jump in beef prices is the perfect synthesis of everything we've discussed today.
Because it touches every part of the supply chain.
Right. Why is a steak so expensive? Because the global energy supply disruption makes it vastly more expensive to run the tractors that harvest the cattle feed. It costs a premium to fuel the refrigerated trucks that deliver the meat.
The physical supply chain is severely strained.
But on the other side of the equation, because the tech sector is booming and consumer banking data shows people still have access to credit, consumer demand hasn't collapsed.
So the farmer pays more for diesel, pays a premium for parts to fix their Caterpillar tractor, and passes that cost onto the consumer.
And the consumer puts that 25% more expensive steak on their Bank of America credit card.
Wow. Demand stays artificially high while supply gets structurally more expensive. No wonder the Federal Reserve is sweating right now.
They are completely paralyzed by this dynamic.
Yeah, we got news on the macro side today from Cleveland Fed President Hammack. He stated that he expects interest rates to stay on hold, quote, for a good while as they monitor data.
And wait and see is basically central bank speak for we are trapped.
Right, because if they cut interest rates right now to help out struggling industrial companies, they risk supercharging the already booming tech sector.
And pushing that 25% cattle inflation even higher by making credit cheaper.
But if they raise interest rates to fight the inflation on beef and energy,
they risk crushing the consumer. Higher rates make that Bank of America credit card debt wildly expensive to service.
which could trigger a massive recession right in the middle of a historic geopolitical crisis. And, the pressure isn't just economic, it's intensely political.
It's coming from all sides.
It is. And again, just impartially reporting the facts from the sources here, Donald Trump has explicitly threatened to fire Fed Chair Jerome Powell if Powell doesn't leave office on his own.
The historical precedent for a president pressuring the Federal Reserve is fraught, to say the least.
Yeah, it's a huge deal.
The central bank's independence is theoretically designed precisely for moments like this, to allow them to make unpopular mathematical decisions without fear of political reprisal.
But when you have structural inflation driven by external wars, interest rates can't actually fix. The political pressure amplifies the paralysis.
Exactly. Hammack's decision to just sit on his hands and keep rates on hold for a good while is quite literally the only logical move they have left.
So what does this all mean for you listening? If we synthesize everything we've unpacked today, the core takeaway is that today's market is defined by a massive tug of war.
A very high-stakes tug of war.
Yes. On one side, you have an S&P 500 riding a historic, euphoric wave of tech and space infrastructure investment. You have companies literally building a new economy in low Earth orbit.
But that explosive growth in the digital realm is masking deep structural vulnerabilities in our global energy supply and our traditional industrial sectors.
The foundation of the physical economy is cracking under the pressure of a $58 billion infrastructure deficit, and everyday consumers are using credit to absorb the resulting inflation.
It's a race between the virtual world's boundless optimism and the physical world's very harsh limitations.
Which leaves us with a final thought for you to mull over today. We've seen how the digital world is racing toward custom silicon and space networks, while the physical world is facing historic energy disruptions.
Two realities pulling in opposite directions.
Exactly. So will we eventually reach a breaking point where the virtual economy can no longer outrun the physical economy's constraints? Can you really build a trillion-dollar network in the stars if you can't afford the diesel to power the launch pad?
That is the trillion-dollar question.
It really is. Something to think about next time you check your portfolio or, fire up the grill. That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.